Hey everyone, today on the final bar, it is Thursday, March 2nd. We'll talk with Mary Ellen McGonagle of Simpler Trading. We'll see which chart she is focused on as we have a nice move to the upside. Nothing like a Fed governor making some comments to put a little more juice in the markets. S&P, the major averages, all finishing in the green. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform was created to focus on three aspects of your analytical and trading process: tools, education, and commentary. And I hope at the end of 30 minutes with us here on the final bar, you will get a taste of all three. Our goal is to illuminate the markets and equip you, empower you to make better decisions using the best practices of technical analysis and behavioral finance. I was taught that price tells you pretty much everything, right? If not most things. It tells you where the market is at as defined by the interplay between buyers and sellers. And if you look at what we learned today, S&P, the Nasdaq, the Dow, all moving higher, right? And again, a little choppier, a little negative earlier in the day, but comments midday sort of move things to the upside. Everything finishing stronger. S&P still below that 4,000 level, so we'll put an asterisk of sorts on the move higher. But let's focus on the up move that we've seen going into the close. Let's get right to our market recap. When we're looking at the major averages, S&P, the Nasdaq, both up about 0.7, 0.8%. Nice move to the upside after sort of a questionable morning. It was sort of a gap lower at the open, but moving higher through the course of the day. Really, again, after lunch when things pushed to the upside, mid caps and small caps both finished all finished in the positive as well. Only red we see on our main equity market index page is the VIX, which tends to move contrary to the S&P. The VIX, with today's drop, almost a point, moving below 20. That might be an important level to watch. We'll try to get to that chart here in a few minutes. Let's check out some of the other asset classes. Rates moving higher, dollar moving higher. So you have sort of one of those weird combinations where stronger dollar, weaker bonds, so higher rates. That in general has meant weaker benchmarks because those two things don't tend to be great for growth stocks, but benchmarks moving higher all the same. We'll talk about the sector leadership in a minute, by the way, because interesting to see utilities and staples, two fairly defensive sectors at the top of the list today. So a bit of an anomaly with some of the dynamics that we see, kind of trying to make sense of today's action. A lot of red here on the page of commodities, but not horrible. You have gold essentially flat from yesterday. Silver prices down about 0.25% using the SLV, and oil just narrowly to the positive. Mostly red on the page of cryptocurrencies. All of them, for the most part, particularly Bitcoin and Ethereum, started to rally in concert with the S&P and the Nasdaq in the afternoon equity session. But Bitcoin currently still below 24,000, around 23,450, and Ether around 1645. Let's look at a chart of the S&P 500 briefly, then we'll come back and check on some other things like sector movements, individual names potentially on the move here. We're looking at the chart of the S&P, and again, I'll continue to apologize for the number of lines that I keep drawing on this chart, but the number of lines for me is sort of an anecdotal indicator of how challenging or how confusing or how unclear this market is, because the more I'm drawing lines, that's me just mentally trying to make sense of what I'm seeing and trying to define some levels of risk and potential reward. And as I'm taking a step back, in some ways, the most clear rotation ever from the distribution phase of 2022 to an accumulation phase that started in the fourth quarter, arguably still there. But that's if we hold some key levels. Now, if we look at the candle chart of the S&P 500, I can't help but notice what I would probably describe as a bullish engulfing pattern. I don't know if it's the most perfect one I've ever seen, but certainly a bullish outside day, which is more of a bar chart sort of terminology, where you have day two engulfs day one, either the body from open to close, which you see here, Or if you just look at the intraday range, a bullish outside day using bar charts is when you have a down bar and an up bar, and bar two, the range just high to low engulfs the first day. So certainly a bullish outside day right at the 200-day moving average is not something that I think you want to ignore. It suggests potentially some short-term strength. But going back to the previous chart, you can see the shaded area, this blue shaded area, which goes between around 4,000 and 4,100. Just like I was super excited when we broke above 4,100, thinking, all right, that could be the clear sign that we're returning to the August highs. That was about it. We went higher by about one day. And then from there, we sort of reverted right back into this congestion area. Now we're below. So I would be much more confident about the upside potential for stocks if we're able to get to, if not through, this shaded area, this congestion area, which we really first started talking about back in November, which was then ended that first leg higher off of the lows in October. So interesting configuration. I know with today's guest, Muriel and McGonagle, we're going to look at a chart of the S&P in a little more detail. So I'll save some further comments for that to just see what sort of patterns and signals we can tease out together. Looking at sectors here very briefly, sort of an interesting dynamic, right? On a day which is rallying into the close, I would naturally look at the list of sectors and expect to see things like consumer discretionary, kind of technology sort of sectors at the top, maybe even things like industrials, right? Which have been, some of the stronger charts in the last 4 to 6 months. Not the case. You see the utilities, number one, up almost 2%. Staples, number two, up 1.4%. Then we see technology and then real estate, which ended up having about the same day, both up about 1.25%. On the downside, the things that underperformed today were financials, consumer discretionary, and then healthcare, which is usually thought of as more of a defensive sector than offensive. So not a real clear signal, I would argue, with the dynamics we're seeing with the sector movements just today. Now, having said that, when you take a step back, you have to recognize, I think, the rotation that we've seen away from some of the sectors that had been working very, very well, like energy, specifically some of the ones that worked so well in the beginning of the year, like technology and consumer, giving way to things like industrials and materials rotating higher. We talked about steel names and building materials and heavy construction recently, all of which, overall are showing a strong price and certainly relative characteristics. I just want to shout out to the top ranked stock in our Scooter large cap rankings. So we have a proprietary ranking system called the StockCharts Technical Ranking, SCTR, or Scooter Rankings. It is not a perfect model. I would argue no models are perfect, but I found it to be a really interesting way of keying in on the names that are working over time and recognizing the ones that are really struggling over time. And again, it's not an end point to your analysis. I think it's the start of an analysis. Focusing on the names that rank pretty high, focusing on the top decile, for example, is a really good place to start because you know that those are pretty decent charts in terms of they've shown some strength over time. But Axon Enterprise, which is a mid-cap defense name from the industrial sector, now the top-ranked stock, it overtook some of the other names that we had talked about, things like what Pinduoduo was, PDD, First Solar at one point. I don't know if Steel Dynamics ever was the number one, but it was certainly in the top 10. Royal Caribbean has been in the top 10 for a while, and I know at one point it ended up being, I think, the number one name, but Axon, AXON is the one right now. And what's interesting about this chart is two things. Number one, how different it looks from the broader market. Like think of a chart of the S&P, think of the chart of the Nasdaq, and then look at this. And it's clear that this is an outlier, right? And the names that you'll see in the top, 10 stocks in the Scooter rankings all look a lot more like this than the chart of the S&P 500 or some of the FANG stocks that might come to mind. The other things to think of, you're seeing some kind of classic breakout patterns, right? The resistance around 195, 190 that we first reached in November, sort of basically a retest of that resistance level in January, February, a consolidation of sorts. I think you'd loosely call this sort of a pennant pattern or something like that. And from there, we resolved to the upside. So the gap higher yesterday, continuing to push higher, closed down a little bit today, but closed higher than the open. And overall, a stock like this finally getting above 200 on a gap naturally makes me think of 200 as a level to watch. As long as it holds above there, this is a good breakout that's probably continuing higher. We start breaking those levels, recent breakout levels, then you want to start thinking about the potential of a downside move. It is becoming overbought here, but on its own, that's never a bad thing. Overbought, as I always say, overbought means up a lot. That's good. But when it stops being overbought, that's when you want to start to be concerned a little bit. Want to look quickly at the VIX, right? The VIX is a measure of volatility. It tends to move inversely to the S&P 500. And one of the things we've been talking about here in recent months really has been as the S&P made a higher low in December, right? A higher low from October, and then made a new swing high there in early February, the volatility remained, fairly low, right? But on the pullbacks, we haven't really seen a spike higher in volatility. I think this was one of the most interesting parts of the December pullback. You had stocks moving lower, back down to a higher low. You would naturally expect the volatility to be spiking up as we went higher. It did a little bit, but then it just sort of dissipated, right? So you had the market pulling back, but not on the spike higher in volatility like we saw in September, October of last year, or in like June of last year, right? We were sort of making a new low and you see volatility increasing, the VIX getting up above 30. Nothing like that in December. And again, in the last 3 months, volatility sort of rotated right around that 20 level. And that's what I would loosely describe as low volatility, particularly relative to our experience in the last year and a half, right? 20 has been a very low number and sort of in the lower end of that. However, when we had a more sustained advance in 2021, look at how the whole range of the VIX actually went down. That's one thing we haven't really seen is a sustained move higher in stocks with broad participation on relatively low volatility. And that would be an interesting thing to note and would suggest that we're starting to look more like mid-2021. For that to happen, we need to get below 20 and kind of stay there. And we've not quite done that, right? And we have these pullbacks and we see volatility spiking up. But again, in the last week, you're seeing the market moving lower, but you're seeing the VIX come down as well. So an interesting diversion from sort of the normal expected relationship between stocks and volatility. Now, other things certainly at play here. We have interest rates to think about. We have the dollar to think about. I was doing my monthly chart review for my Market Misbehavior Premium members earlier today. And one of the charts set of charts that we focused quite a bit on were intermarket analysis charts, thinking about interest rates and what that means relative to risk assets. Here's a chart of the 10-year yield. We can see that interest rates came off in January and look at how it turned right back to the upside in February. Now, what's interesting is, and you can see here, it's kind of below this bright red arrow that I could probably get rid of at this point. Here you can see that value stocks were underperforming growth stocks in January. So this is as rates were coming off. And growth stocks like the FANG names were actually doing quite well, right? Coming off of it started the new year brilliantly, coming off of the higher low in December and pushing to the upside. But look at how while rates have gone higher, which would make me think value stocks are probably outperforming, hasn't really been the case. Value and growth have been net even, and that's using the two pretty widely used value and growth ETFs. So it tells me that it's not been as clear cut of a value versus growth, offense versus defense. It's a little more nuanced. When we come back from the break, we have a great guest to ask this question. Mary Ellen McGonagle will talk about some of the areas of the market where she's seeing some opportunities, giving everything we've seen in the markets here year to date. We'll come back in just a moment with Mary Ellen McGonagle. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close. It is a pleasure to put the show on. We have a lot of great plans for the Final Bar through the course of this year, including moving to our brand new studio, hopefully very, very soon. We're excited to share some really cool visuals and new segments with you. A couple quick announcements before we bring on today's guest, Mary Ellen McGonagle. First off, we welcome your questions. You can access us via email. That's the best way, thefinalbar@stockcharts.com. You can also hit us on Twitter @FinalBarSCTV and on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to hear from you and answer your question live on the air tomorrow on Friday's show. Also want to let you know about the upcoming guests. We have a great guest today, Mary Ellen McGonagle. We'll bring her on here in a few moments. Next week, on Tuesday, March 7th, we have Mike Zaccardi. Mike's an investment writer, a contributor to StockCharts.com, focuses on technical analysis for financial advisors. Should be an interesting conversation about how advisors may be approaching this particular market environment and the uncertainty. On Wednesday, March 8th, Aaron Swanlin of Decision Point will be coming on the show. And then I'm really excited to moderate our latest episode of The Pitch, which will be coming up next Wednesday, March 8th as well. My guest today, Mary Ellen McGonagle, will be joining us. Also, Aaron Swanlin and Mish Schneider of MarketCase. Should be three fantastic, knowledgeable expert panelists, each pitching you 5 different stock and ETF ideas. Go to stockcharts.com/thepitch for more info on that fantastic ongoing series. I want to welcome on today's guest, Mary Ellen McGonagle. Mary Ellen's the Senior Managing Director at Simpler Trading, coming to us from Southern California. Mary Ellen, it has been too long since we've had you on the show, and welcome back.
Oh, wonderful. Great to be here, Dave. Thanks.
So I think investors certainly have a lot of questions. It's been a challenging market with a lot of turns. We were talking before we started, the last time you were in was sort of mid-2022, and we're starting with the chart that you shared with us then. Talk to us about what you saw then and how that's changed.
Yeah, absolutely. This is mid-June 2022, and we're looking at a monthly chart of the S&P 500. And what I was highlighting here was 2 prior bear markets. That would be the 08, 09, and then the 2000 to 03 bear market. And both times on that monthly chart, a negative RSI coupled with negative stochastics foretold further downside. So in June, that very same dynamic that week I was here had just occurred. The simultaneous negative RSI with the stochastics. For those that were thinking maybe we could be close to getting out of the woods, this was a signal not so fast, more downside ahead. So that was the case.
And I love the long-term view. I love starting with the monthly view. I so appreciate that you started there. Show us what happened now, because I love how we've updated this chart. What is it telling us about the current conditions?
Yes. So here we are, same monthly chart of the S&P 500. And you can see that the dynamics relative to the momentum is shifting. The stochastics are trending upward. Super good news. And the RSI is positive, but it's a little waffly. We're not seeing a lot of real momentum. It's more of a sideways move, but I'm going to take it. It's in positive territory. Does not mean by any stretch that we are out of the woods yet, but it is showing some very positive initial signs of, at the very least, firming up. So I like what I'm seeing here.
So no doubt that it's been a really, an encouraging start to 2023, certainly out of the higher low in December. The markets sort of moved to the upside, but February, a bit of a question mark with some of the major benchmarks coming off a bit. Talk us through your daily chart of the S&P. What levels are you paying attention to? What's your assessment here?
Yeah. So Dave, you talked about that 4,100. That was all a very critical level. We did trade above that. Super exciting. Since then, of course, we've lost that potential area of support. From there, I then move into using moving averages. I use simple moving averages. We were sort of finding support at that red 50-day. This week, we did lose that. We are just barely clinging to that 200-day simple moving average. That's the blue line. So that is the next or current area of possible support. At this time, if we break below that 200-day simple moving average, I'm going to be looking at those December lows as that next area of support, and it's about 3.8% away from where we currently are. You can see the momentum also, the RSI and stochastics are both in negative territory. So currently we are in a near-term downtrend from my work.
So if what we saw on the monthly chart follows through, and this is the beginning of sort of a broader improvement, which certainly would be in line with more of the seasonal tendencies, right, in a pre-election year, what would you see on this chart that would confirm for you it's lights out, thumbs up? Is it an improvement in momentum? Is it recovering back to the February highs? Some combination of those?
I think if you pull up, I did provide, there should be a chart of the Nasdaq, and we can use that. It's also a daily price chart, and take a look at the momentum shift that took place in the beginning of this year. Everyone, I'm sure you recall, January was a wonderful month for growth stocks and for the Nasdaq. But if we look at the momentum, the stochastics did enter into positive territory there, simultaneous with an RSI also going into positive territory. And then, of course, you want to see that given index break above those key simple moving averages. In other words, they are bypassing that upside resistance. In the beginning of January, we did get what is called a follow through day. That is a William O'Neill metric that has called every market bottom, whether it's near term or longer term. And of course, in this case, it was a near term bottom that was called. It takes into account volume characteristics as well as the percent increase on a given day. And so we had three different items that took place, signals that told us that that downtrend had reversed. So that is what I will need to see in the S&P and the Nasdaq as well. Get that momentum in positive territory, get the index moving above resistance, which is those shorter term moving averages.
I love that. So use the Nasdaq and that improvement you had off the lows as a model of what we could see for the S&P, where the momentum indicators kind of get back above that 50% level, right?
You're right. Yes.
So with that as sort of the backdrop of where we're at, if you had three levers you could pull at this given moment, and lever one was sort of the growthy stuff like tech and consumer, lever two was sort of the traditional defense like utilities, and then level three, some of the cyclical things like industrials and materials. Which of those levels would you find yourself pulling and why at this point?
It's all going to be about your outlook and your trading length of time that you plan on staying in a stock. I did your daily 5 on Monday. I chose 4 consumer staples stocks. They were staples names that had provided growth. They had just released earnings and they had nice high yields. But if I'm thinking longer term, that is not going to be my go-to. I'm seeing some vibrancy continuing to bubble up in that tech sector, semiconductors in particular, and then software did turn positive today. If you look at IGV, we had Salesforce, CRM, and several other heavyweight names that did come out with earnings that were quite constructive. So that is going to be my go-to. And really, when you look at the bigger picture and the broader markets, we will need to see technology and consumer discretionary come to life. They account for 40% of the S&P 500. And unfortunately, if you look at XRT and even the consumer discretionary sector, you will see that it is not acting well currently in the near term. So longer term, however, for me, it is going to be about growth stocks. And then, of course, we did speak before the show just momentarily about this move in industrials. And if you look at a monthly chart of XLI, it is the only really the most constructive looking chart at this time. And a couple of factors at play here. One is this area is really knocking the ball out of the park relative to earnings coming in above estimates. I am calling this period the new industrial revolution. It's all about these industrial companies that are embracing technology. They're using AI so that they can improve productivity and therefore improve their bottom line. So there's a lot going on in industrials that does not meet the surface, but is really quite exciting.
It's so funny to me, Mary Ellen, because when you think about AI, one of the more, and not to call it a fad, but one of these topics that come up, and when people think about how to play it, they try to find new emerging, tech companies that would play it. The reality is it's going to hit in a lot of different places, right? And it's sometimes not particularly clear who's going to benefit from that, right? Is it the larger, more established corporations that are able to pivot to that? That certainly
you can look
provide
at
some upside.
Caterpillar or Deere. Both of them have mentioned it strongly in recent earnings calls that they are embracing. Caterpillar is using AI so that they can detect defects within their large machinery ahead of time before it's known. And then Deere, of course, is helping the agricultural community really increase their productivity. And it's all about embracing that technology to that so that they can help their companies and their customers improve productivity.
Oh, it's fantastic. I like, one of the trading maxims I was taught earlier on was a rising tide lifts all boats, right? And you need to pay attention to the macro environment. And if the indexes are doing well, then stocks are probably doing well, and the opposite. Do you think that's fair to assume at this point? Or is it more of there could be a disconnection between, I'm thinking of Caterpillar, like steel companies that have just been exceptionally strong while the indexes have languished. What would you expect here going forward?
Yeah, that's a great question. Well, you can look at STLD this week, NUE. A lot of those names are on the move because China came out with numbers earlier this week. Their manufacturing activity at a 10-year high. They're amazingly well above estimates. So we are seeing a move back into these basic materials types, and then also the Caterpillars of the world, the more global facing companies, given that China could very well be in a big expansive move subsequent to their reopening.
It's such a great point. And I love how you, as always, you make sense of a confusing market. You make it seem very easy, Mary Ellen. So thank you so much for that. But I appreciate you talking through some of these names with us and the big picture. Thanks for showing us how the picture has changed from 2022 to 2023. We'll have you on again soon. And it's a pleasure to see you, Mary Ellen.
I look forward to it. Thanks, Dave.
That's Mary Ellen McGonagle. Mary Ellen is the Senior Managing Director at Simpler Trading, coming to us from Southern California. I love Mary Ellen's approach. If you picked up on it, talking about follow-through days, she's worked with the O'Neill crew and the O'Neill methodology for years and years, and applies that wisdom so brilliantly to making sense. And again, my formative years as an analyst, as a technical analyst, was reading the IBD every day and looking at these great examples of growth stocks that are working. So it's so refreshing to have a conversation with someone like Mary Ellen, who's just a reminder that those techniques and those approaches still working just fine, right? Focus on strength and focus on opportunities when you're looking at equities and ETFs. Great take there from Mary Ellen McGonagle. Let's continue on our show today and wrap it up, folks, with the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Chart number 1, Salesforce.com, certainly in the news a lot recently. And it's funny, I was looking at emerging technology names, talk about, areas of and types of companies that are trying to capture sort of the next generation of where things may be headed technology-wise, and Salesforce certainly comes to mind. Has gone through some changes here recently, as many technology companies have. That news has been digested pretty well, and a gap higher today with CRM up about 12%. Now, what's interesting is we gapped up to the same level that we were in mid-2022. And that was so interesting on this chart to me. We pulled back to the 200-day moving average going into last week, going into this week. We gap higher today on earnings. We're now in this blue shaded area. And this comprises 2 levels. Look at the resistance we saw in June of last year and August of last year. Again, that was a pretty major top in both cases for the S&P, but we've now rotated round tripped back up to those levels around 195. That's also the first big Fibonacci level. If you take the November 21 high and the December 22 low, you take 38.2% of the way up. It's just below 200 at 197. So for me, impressive gap higher. The challenge is we're gapping right up to resistance. My question would be, is there enough additional momentum? Are people not just cashing out and thrilled that they made it back to the entry point here from 2022? Are additional buyers coming in? Today, you're not seeing that. You're actually seeing the stocks sell off through the course of the day. I'd love to see if there's additional momentum to push us above 200 on a chart like that to get more interested. Speaking of stocks moving higher up to resistance, Tesla sort of in the same situation, right? Take the same time frame here of November 2021. The low came a little later for Tesla here at the beginning of 2023. But if you look, we've now retraced almost exactly 38.2% of the way up, back up to those 2021 highs. What's interesting is that also lines up with the May-June 22 low, and also we're right below the 200-day moving average. This is a concerning combination of what I would call a confluence of resistance. It's not that stocks can't power through something like this, and there are plenty of examples in market history where stocks have done exactly that, but it's a question mark. It's not a given, in my opinion, on a technical basis, that Tesla will be able to push above 220, which would get us out of this resistance area, above all of those levels, and certainly above the 200-day moving average. If and when it does, though, that tells you additional buyers, again, are coming in, and most likely that tells you more highs can be experienced. Final chart of the day here. Again, I did my monthly chart review earlier today for premium members, and this is one of the charts we looked at, looking at the year-to-date performance of the 9 Morningstar style boxes. I threw micro caps as a 10th piece on there. In previous times when we've looked at it, it's been about growth versus value, and the value ETFs at the top, the growth ETFs at the bottom. Year to date, it's actually been more about size, right? So the 3 large cap ETFs are all at the bottom of the list, up about 4% year to date. Small cap value up almost 11% year to date. So just being in that particular part of the US equity space, and you've been outperforming handily so far in 2023. Folks, that's a wrap for the show. Thanks for joining us every weekday after the close for the final bar. Special thank you to Mary Ellen McGonagle of Simpler Trading, joining us from California. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.